bring in Sylvia Jablonski, CEO and Chief Investment Officer of Defiance ETFs. I don't want to talk about them, Sylvia, although we can. I want to talk about your comments about how important this week is, because it's going to give us a look at tech. And there's a couple of reasons that you point out. Number one, just the leadership that we've seen in recent years that tech has exhibited. So it's a psychological thing. But also, these companies give us a really good look at what's happening in the economy, whether it's advertising or commerce or whatever you want to look at. So this is, in your view, a make or break week.
Absolutely. And good morning. So, we've seen about 13 trillion taken off the market, and a lot of that has come from the big tech generals and the NASDAQ. Major indices are essentially getting crushed this week, and they've led us on the way down. Historically, we know they've led us on the way up. So this quarter is particularly interesting because we're sort of at the crossroads of the kind of unfriendly Fed, inflation. The first two quarters held up okay. Earnings are holding up okay. And I think that for the average company, the average Dow, S&P stock, if they kind of don't come out with terrible news or terrible guidance, that will be a win in this type of market. But I think that if Apple, Microsoft, Amazon, Alphabet, if they have big misses, I think that's going to really impact the market in the short term in a negative way. So if you have VIX sitting around 30, any of these names come in with any kind of like terrible or unexpected, negative guidance, I do think that in the short term, we're going to get a pullback on that. On the other hand, if it looks like, enterprise and consumer spending are holding up, and that's what these names really tell us, whether it's Amazon through e-commerce or whether it's, Microsoft, Alphabet on cybersecurity spend, investments in sort of the future 5G, quantum computing, things like this, that tells us that these companies perhaps are slowing down, but that everything is, okay. And then we'll have to look at their balance sheets. They've been historically strong. Most of these companies are sitting on a lot of cash. Some of them may pay out some good dividends. So, long story short, I think if they sort of meet or beat, that's going to be a really good sign for the market. And we could get that year-end rally that we're hoping to see. I think that if they miss, though, we're definitely in for some short-term pain. You
actually use the term "on the other hand," like John Fort. Yes. And you actually started with the one you don't. He always ends with the one that he has the more compelling argument for, in my view. That's probably not true. So you started with the negative case, but then said, so if they don't disappoint, and I wish we knew, and you must have a feeling one way or the other, 55-45, 60-40, you said a sustainable rally into year end, which could bring us, let's just take, for argument's sake, let's say they're solid or better than expected. Where could that take the S&P? Back to what, 42, 4,300?
Yeah, so I think, if you sort of look historically, the median return of the S&P 500 for this period from sort of October till the end of the year is about 7% up from here, So I do think that if tech, stays steady, we could see that level of performance, that 7 to 10% move. And I would argue even higher if after November, the Fed comes out and does that 50 bips instead of 75 bips, because I think now, pivot actually just means a little bit less, and the market will be sort of happy with that type of news.
Right.
So that's where we stand. But
swivel,
yeah. And, to your point, I'm probably 60-40-60 that it's going to be okay.
Really?
I don't think, I don't think Meta is going to be great, but I do think Microsoft, Amazon, Alphabet and Apple are going to hold up okay.
And then
there's this big.
So Meta's down how much? 60%? I mean, Meta's at 65%. It's already sort of telegraphed that. Yeah.
Right. It is. And I don't have a whole lot of hope there just because, it's the advertising spend is not, search engine spend like it is for Google. Your last guest talked about that too. But also nothing has really come of the metaverse besides, sort of big costs and bills. So until that gets sorted out, they have a great user base, but I'm just not going to put my money there. I am comfortable, though, investing in some of these other companies that, again, are part of enterprise spend and the consumer, which is holding up okay.
I confess that when you said if things are not as bad as expected for tech, I hope the Fed doesn't look at that and say, wow, we have more work to do. It's so warped the way we view everything now.
It is.
If tech says, yeah, things are pretty good, really, and, then the Fed's like, oh, crap, we have further to go. So we have to qualify everything. I'm glad you'd use that on the other hand. I don't think he's actually trademarked that as of yet. But
Shepard Smith here. Thanks for watching CNBC on YouTube.